All right, so welcome to episode number 125 of Let's Talk Stocks. Today we'll focus on contrarian trading, which doesn't mean you don't follow the trend. So that'll be the core of the discussion. I'm going to also focus in on your few questions that you have right here that I have from the live session. So this will be actually posted on Thursday for those of you that are not watching live, about how to monitor and close positions on the losses and a little more on Vega and setting up the position. And we'll target that for contrarian trading as well. So, of course, before we get into any examples, keep in mind that all these examples are strictly for just educational and illustrative purposes. I think you guys are smart enough, you understand that. So take that with a grain of salt and look at your own personal trades that you're doing and apply those concepts based on your risk tolerance, based on your risk levels. So in either case, let's take a look first at a few things regarding what is a contrarian. So in the marketplace, we really have two main kinds of traders, you could say, if we're talking about contrarian traders or people who follow the herd or the herd mentality. I typically don't like to use the word herd simply because I don't like the appeal of that word. But in either case, it's people that are usually contrarian or people that follow the group of people, the group of other traders. And if we know and understand that 90% of traders actually lose out and only 10% actually win or are meaning by win I'm referring to are profitable in the markets. I'm not saying they don't ever lose. I'm saying they're consistently in the game for the future to be able to make money time and time again for the long haul. So if 90% lose out and only 10% actually win in the markets, doesn't it make sense to be a contrarian? Well, what is a contrarian? Contrarian really just means you go opposite of the group or the herd mentality. But how do you do this in the marketplace if all those idioms or all those phrases always say, follow the trend, follow the trend? You don't want to go against the trend. And that is true. You don't want to go against the trend. You want to go with the trend. But that doesn't mean the risk management that you have on your stocks is not contrarian. So I'm going to share with you some examples on charts as we get into this, and you'll see exactly what I'm talking about. So for many people, as they go into the marketplace, okay, we'll just talk about just a general person. For many people, as they get into the marketplace, they normally will get into higher levels, and we'll just use Amazon here as an example. So what happens is as the market, let's just say we're starting out here and we're watching Amazon, as the market starts climbing higher, this is usually when, call it the regular mom and pop, the Joe Schmo, they get interested in the stock market. So as they get interested in the market, this is where they say, hey, wow, things are climbing. Let me set up a trading account. So then they start setting up a trading account or they think about their decision. As this continues to move higher, then they say, okay, well, I'm going to go ahead and fund my account. By the time they fund their account and they slowly start getting into the positions, probably buy already right now, right here at this stage and this point. You may say or think, hey, this is silly. But if we go to the original concept and understand that, well, 90% of traders actually lose out, don't make money, or, get faked out, then this is not such an unrealistic statement to make that many people get in or the retailers get in by this point or at this stage. Even if you play a little more conservatively, you could say, okay, well, say they're a little bit smarter, they get in somewhere at this stage. But then what ends up happening is they get this euphoric rush, just like we have here in Amazon. Doesn't matter which stock you apply it to. Could be Facebook, could be Amazon, could be the Snapchat IPO coming out. They get into the stock, And they might have a few days, a few weeks of a nice run, and then eventually things start to roll over. And because they have less experience or seeing market pullbacks or they got in it late, they're following the trend because this initially was the trend. Okay, this was the trend. And although this was the trend, their process was actually incorrect. Okay, and the process of doing the trade was incorrect. So when you look at it and they get into it, eventually these things roll over and they end up selling kind of at the lows or somewhere around this level, either breaking even or even losing out. And if we get into this more on, let's say, the daily, and you can look at it on a daily chart, maybe for some of you that watch the daily stock charts, let's say Amazon starts climbing here and it's going higher, and now you see it spiking, and let's say you see it spiking and breaking out at a certain level, and you say, okay, I'm going to get in it right here, and you didn't bother checking the weekly charts. Okay, say you're just getting in new, fresh into stocks, you didn't bother checking the weekly charts, and even though this is with the trend, it's to the upside, and investing is to the upside in general, eventually this stock hit some highs and had a big rollover. So for this regular person right here, when we had the support coming in right here, that ended up getting taken out, and now you get emotional about it. And this ended up continuing going even lower to this point, to the fact of you creating an even bigger or deeper loss. So this really creates some major problems with traders, especially if you're new or if you don't know how to manage the trades, if you're not experienced, because you're constantly taking losses. And one of the reasons, not just the only reason, but it's just one of the reasons that many beginner traders lose out, and 90% of traders actually lose. So this is one of the big picture concepts. Now, as far as a contrarian goes, the inverse of that, or the opposite of that, is, let's just say here in this situation, you were buying things when everybody was screaming to buy. Okay. You're following the herd. Okay. You're going with everybody else. You're buying when everybody's buying. And then what do we know that happens to stocks? Well, they don't go straight up, they don't go straight down. So when everybody is buying, okay, and you're buying, eventually a few days later or a few weeks later, it rolls back over because we know that rubber band gets stretched, so then the opposite happens. But what happens if you're the contrarian? Well, the contrarian works opposite of this. So you're typically a buyer when everybody is a seller, and vice versa. You're typically a seller when everybody's a buyer. So here, when you look at this trade or this trend area, so even though we look at the trend, okay, Amazon's going up, heading higher, and so on and so forth. That's our weekly. So I know the bigger picture. On the weekly, I know that the trend is still to the upside. So what do I do, or what do I think about it? Well, my mentality is actually, and they call this, buy the dip mentality, but you don't want to just buy like every little dip that's, 1 point here, 1 point there, 1 point there. I think people on social media get a little bit too extreme with buying the dips, so you can't think of it that way. But you're actually looking for legitimate, nice pullbacks that have some substance. And a pullback such as this one actually has some substance. Now, I don't think Amazon's going to go bankrupt in the next, 6 weeks or the next year if the trade is looking for 6 months out. A pullback like this, where we pull back, let's say from the highs, we did about 120 points. That's a pretty nice pullback. And ultimately, this one is 14.3%. So typically, what you do as a contrarian is you're buying, okay, as things pull back, and you're not going to hit it perfect. You're not going to hit the tops on the stocks when you're selling, even if you're going long, and you're not going to buy at the bottoms if you're bottom fishing. So the same thing, you might buy, let's say, a third of your position here, a third of your position here, maybe your final third. You might not be able to hit the bottom over there, but let's just say another third somewhere over here where it's bouncing. And at least you kind of have an average position of somewhere over at this price point. That way, eventually, as this stock comes higher, which again, we follow the trend, and now as you do the proper process, you're taking off, let's say, a third here, and a third, over here. So again, as we get into resistance, there's your third, there's your third. So as we start hitting things, you're taking off most of your positions, or maybe you just do two of those thirds and let the rest ride and see how far you can get, or maybe add on to it on the next pullback. So that's the contrarian view and the contrarian concept to trading. That doesn't mean I'm going against the trend. It just simply means you're putting on trades at a different point in time than everybody else. And this is typically where you make money. This is typically the way money is made in the markets, is going against the majority. Again, it also depends on your trading style. If you're more of a day trader, then typically you might want to play things a little bit differently, but the same concepts and theories still apply, because when the market is high, right? When it's overstretched and overextended, what's going to happen? Think of it like a rubber band effect, right? You'll see prices head lower. When the market is low, or prices are overextended, let's just say from our moving average right here, when the market is low, what's going to happen? Well, you're going to get that bounce, right? So the same thing happened when we went with when you look at the Trump era right here, when you look at the Brexit time frame here, when you're too far extended, you get that whip back, right? And the same thing on the upside. So if you look at it, okay, so if you look on the upside, so let's just take this point right here, you're too far extended. What happens? Well, you get the pullbacks. And then again, you get this little consolidation, but you get the pullback. Eventually, that's what happens. And the same thing, in fact, looking at the current market conditions, for me, as I look at it, even though we have so much rocket fuel in this market is powerful. It's relentless. It wants to keep grinding higher. But if you watch the tulips and the bubble episode that we had just a few weeks back or a month or two ago, we talked about how far can they stretch it. And they can stretch it a while, and they can keep stretching it maybe for another year, maybe for another two. But keep that in mind, that the more you stretch, the more that rubber band is stretching, and you want to be taking profits into these moves, because they call it the dumb money versus the smart money. The dumb money usually are the people, if we go back to the Amazon example, it's usually the ones who are getting in with this euphoria high where Amazon's hitting highs, and then eventually it rolls over, and then they're trying to buy back their shares, or meaning they take their loss, right? So that's typically the dumb money. The smart money is usually the ones trying to buy on value, and then as prices continue higher, they're patient. They take a third, take another third, and then maybe hold on to the last third. So the same thing here. When I look at a market like this, just referring to our current market situation, I'm looking at how far stretched is it? How far can we continue going? Now, for some people, they may say, okay, well, can we get to, we're right now, call it 2,400 for conversation's sake. Can we get to 2,500 by the end of the year? Possible. Okay. For some of you, you say that's reasonable, that's realistic. For others of you, let's say, okay, we go to 2,600. How many of you would think that's reasonable? Probably less people. So if we had 100 people, I would say less people would say 2,600 is reasonable. What about if we go to 3,000 or 3,100? Is that reasonable by the end of the year? Again, once you keep stretching things further and further, you start creating that effect. And that's where you have to look at that in a bigger context, saying, okay, well, where am I going to take my profits? And this goes back to our question here initially, is how to monitor and close them to prevent losses. Well, you're taking profits always into strength. I didn't understand this the first few years of my trading. I didn't do that. I would always get in a full position and get out a full position. I didn't realize and recognize that, having, let's say, 100 shares, I could take off, let's say, 30 and another 30 and reduce my risk. And the same thing here. So if you're trading in this, and let's say you got in it even here or here, it doesn't matter where you got in it, but you could take, let's say, a third or a half off or a quarter. You take your profits, because you don't know if you might get, something like a down day like this, or, all of a sudden something like this just starts to kick in, and you have no idea when that's around the corner. Sometimes you get like a little mini pullback, like over here, and they can just wipe out like this one day. I'm going to show you one day right here. This one day, this one bar on the S&P from here to here was a 52-point move. It wiped out from July to here 2.5 months. 2.5 months. And I've seen this happen in stocks where it wipes out years of gains in one day. Years of gains in one day. So that's why you're always peeling things off into strength. The down moves are always more violent. So in either case, looking at it from a contrarian standpoint and a regular person standpoint, just because you're following the trend doesn't mean the way that you handle your process has to be with the same way that people follow the trend, right? Because most people who follow the trend, if it's an up day, they buy on the up day. If it's a down day, they sell on a down day. Oh, it's selling. I'm in panic mode. Typically, if you're looking at this market and if you're not winning out or if you're not making money or if you've struggled, making a profit, then usually it's because of these. Or think of it and think of trading in a different way and doing kind of the opposite of what it is that you're currently doing and see if that would make sense. Because I personally don't know you. I don't know how you're trading. But if you're doing the same things, you've been trading for a year or two and you're making the same mistakes, but you're buying on green days and you're selling on red days, why not try something a little different? Because after a massive couple of green days, eventually you know that things pull back, reverse. It doesn't matter which stock it is, whether that's Tesla. Take a look at this, how far of a massive move you've had, right? After you get that massive explosion, eventually that stock comes back, right? They don't go up forever. So in either case, that's just some insight on the contrarian side, but here comes the bigger insight. Okay, so we have this concept in mind, but then what do we do as far as emotions go? So sometimes emotions get the best of us or they start playing tricks on us, and this is what typically will happen. So say you got into this market and we're just pooling here on this down move. Let's just say we're talking about this down move. So you might have you saying, okay, well, it's having this little pullback and you get in it on day 3 or 4. Okay, it's had a little pullback. You got in it on day 3. You got in a little bit on day 4. You got in on day 5, and it's still going down. And your position continues to be negative and negative. And emotionally, this is ultimately very difficult. And that's why trading is so difficult because it plays on these emotional concepts that are naturally against you, but you have to know and understand the bigger picture on the long-term scale. What's going to happen to these markets? What's going to happen is that you're already you're buying it so far down. If you play the game of Pong, right? You play this game of Pong, let's say left to right, and you flip that, and you're doing the same thing. If prices are stretched to the bottom or really low, even though they're at low points, doesn't mean they can't go lower, but eventually they'll get into higher territory, right? Because stocks typically in general are looking to appreciate, and that's what you're doing is you're trying to get it, between these ranges, let's say, you're trying to get it at a lower range rather than, let's say, the moving average is here. So if you can get it at that lower value, eventually we're going to snap back. And this is the hard part, is that emotionally you're seeing this day in and day out. It's painful. And then again, it's painful. Then you might want to wait. And then again, it's painful. Now, this is called averaging down. Now, normally I wouldn't recommend averaging down unless you have the appropriate process in place, meaning you have that plan in mind that you're doing it in, let's say, quarters or thirds. For many people, averaging down, meaning if they have $10,000, they buy $10,000 of stock and then the stock goes down and then they put in another $10,000 from their bank and they average down again, a week later, and then again and again and again. That's just emotional trading. That's trading without a plan. When I'm talking about averaging down, I'm talking about creating a position. Like in chess, you're creating your position. First, you set up your position. Once your position is set up, you attack. You attack, you set up that position, you further attack, and then eventually you conquer and you get your trade. So the same thing here is you're building out your position to where eventually you get that snap up, and then you start taking shares off, and then you see if you let the rest ride. And then again, if you get a little pullback, okay, you're buying, okay, and then again you get the snap up. So that's kind of what you really ultimately should look at, is that when this happens and you're in an emotional state, is that many people, they're just constantly getting beat. And the same thing, if you're doing this on the short side, let's say you're in this market and you're short this market here, and then you're short this market here on these big up days, sometimes it can be brutal and emotionally damaging and emotionally tired. And you have to know, when is it that you're either A, taking a loss, or B, where is your adjustment? Because if you have no plan, like in chess, if you have no plan, if you have no plan in mind, even when you are doing this downside move, that if you have no plan, eventually things will burn you. So you need to have a plan, that what if things go against you? And you might need to endure that pain for a little bit, and then you'll get that snap down. Just like with Amazon, if you were looking to short Amazon, let's just say you're a person who shorts Amazon, and you said, okay, well, I'm shorting it here, or whether you're doing it with options, I'm shorting it here. And, you're in pain now. If this is the two times you shorted and now this stock continues to head higher and you're short, you're in pain, and you're feeling that. That can be emotionally problematic and very, very stressful on you. But eventually, you either have to, number one, know where that loss is, that loss point, and where you take that hit, or number two, where you make the adjustment, or once things kick in, and if you were able to hold out, now you let things cook and let things work, and then you have to take your profits. Again, same thing in the strength, because those things can whip back. So again, you're taking your profits, you take some more profits, and maybe somewhere over here, again, you take your profits. So that's kind of the nature of doing things a little bit more contrarian, or thinking about things in a contrarian way. And if you're always following the herd, if you're always following everybody else, this is one of the main reasons why a lot of people lose out, because they follow people on stock twits, on Twitter, even me. I always say, you don't want to follow me blindly. You can follow people. There's nothing wrong with that if you're looking to have, a newsletter, or you're following other people, because I know even my newsletter is not every day. I don't release a daily newsletter because stocks whip around on a day-to-day basis. But if you're following people on a day-to-day basis, you can get whipped around. And it's okay to do that, but you have to have the bigger picture in mind for your plan, for your ideas, for your concepts. Otherwise, the market's just going to whip you around. So in either case, if you're always getting in with the herd and you're following the same thing, you're buying on the up days and you're constantly getting burned only to see the stocks roll over, you're probably buying too late. And the same thing if you're shorting. If you're shorting on down days, let's just say stocks have been going down for a while right here, and you're starting to short over here, you know, it might already have been too late. The time to short was probably when stocks are making this incline move to the upside. That's the time to short, is on this move. Endure a little pain to get that reward later. You sacrifice a piece or two on the chessboard to get that reward later. And the same thing here. If you're looking for a long position and you're getting in right here and right here, endure a little pain so that you can get a lot more pleasure, right? So I hope that makes sense in today's lesson. I do want to cover this a little bit more with the Vega and the options, when it helps, when it hurts, just selecting a good position as well. You want to do the same thing when it comes to an option, the same exact way when you're talking about options. So I'll talk about this I hope a calendar position's okay, and people, you guys understand a calendar position. Let me use Amazon since that's the one we've been talking about, because calendars have a pretty good Vega. So typically, if you look at a calendar, and we'll just say we'll buy a calendar here. Let's see what we have. We have an April and we have a May. Okay, so Let's take a look. April and a May, that's what I want to do. We'll go ahead, we'll buy a calendar. So we'll sell the April, we'll buy the May. Yep, analyze the trade. Let's take a look at what that looks like. Okay, let me remove these sample positions. Okay, let's get it to, let's say, what is the current price? The current price is 853. So call it, let's say 860 is our calendar. That's fine. Okay, so when it comes to a calendar, okay, here's the baseline for putting on option positions when you're looking at your Vega. And again, normally I would say you got to be a contrarian. If you're putting on option positions, you want to be a contrarian because you're typically not holding these for 3 days. You're typically holding these for a week, 2 weeks, 5 weeks, 6 weeks, 8 weeks, depending, could be a half a year. So you're putting these on and you're holding them for quite a bit of time. So when you look at a calendar, this position has a positive Vega. If you look at an iron Condor, it has a negative Vega, which I'll cover here real quick in a second. So when we look at a positive Vega on a calendar right here, when is it a better time to put on this calendar? Well, here, I'll show you the example. First, let's look at how the Vega works. Well, if I take out this more parameters area, when does it help you to the calendar in terms of just volatility as far as this calendar? Well, if I bump the volatility up, look at what happens. So we're up about 3 points on volatility. The calendar expands and grows. Okay, so you can see right there, calendar expands and grows as I bump the volatility. As I decrease the volatility, the calendar contracts, right? So what do we want to do? Well, we want to typically put on a calendar when the volatility is low. Why is that? Well, because we're buying time, right? We sell one in April and we buy one in May. Okay, so if I look at this right here, we sell the April and we buy the May. Okay, so we sell 51 days worth and we buy 79 days worth. That means we have a positive of, in excess of that many of days. So whatever it is, 30 some days. So anyways, so you're basically positive time, which means you're positive Vega right there, right? So you're positive volatility because you have more time. You're purchasing additional time premium. It's not in 1 month. So typically you want volatility to go up, right? You want volatility to go up. So when is it better to put these things on? Well, with a positive Vega, it's better to put on calendars when volatility is low, okay? Because we want volatility to go up, right? So calendars would be better to put on when volatility is low, kind of like right now, actually, So putting these things on right now, okay, because that's kind of a lower volatility area. We're kind of getting into a little higher volatility, but in either case, it's relative to the time frame you're looking at. But the lower the volatility, the better to put on the calendar. So when do you want to do it? Well, on days that are massively up days, like today. Today we had a massive update. How is Vega related to the VIX? Well, the VIX basically, okay, so the higher the VIX, when you look at the VIX, it's basically depending on how options are priced. And maybe this will kind of answer that question. So let me finish this train of thought. As we look at this and we pump this higher, okay, right? So as stocks pump higher right here, as we go higher, and this is a lot of things to think about, that's why I'm talking a little bit slower. As we pump higher here in the S&P, the VIX normally drops, okay? So if you look at the VIX today, you can see we dropped about 0.38 right there, okay? So as things go higher, the VIX usually drops, which usually is a good time to put on a calendar because we're positive Vega, because we anticipate in the future a rise in volatility. So when you look at how Vega compares to the VIX, is the higher the VIX, okay, so if I look at this VIX and I look at the VIX right there, the higher this VIX, in general, the more the option premiums are sold for. Okay, now here we're buying Vega and we're buying time, so it actually works a little opposite. Maybe with the Iron Condor example, it'll answer that question a little bit better. So in simple terms, if you have a calendar and you have a positive Vega position, you want to put these on in general, just like we talked about the contrarian concept, on massive updays like today, because the VIX gets crushed because eventually we're expecting a higher VIX. So after the markets go up 2, 3, 4 days, this is a good time to put on a calendar. And the same thing on the opposite side is true. If you're looking to create an iron condor, let's just do an iron condor right here, and we sell an iron condor just as an example. Analyze the trade. We'll do the calls on, let's just say we're way up in the 870, call it 885, probably even higher than that, 900 and 885. And here we can do maybe 805. Let's just see what this looks like here real quick. Not wide enough. I think we should go just a little bit wider. Let's just go here just for as an example. Okay, 795 and 805 and then 910. Okay, so here on an iron condor that we have, and we have a volatility that's adjusted right there. On an iron condor, let me bring this volatility back to 0. On the iron condor, you're negative Vega. So if you're negative Vega, okay, that means you make money when what? Well, if I move this down, the volatility down, that means prices contract, meaning the prices of the options contract, which also means the speed, because volatility refers to the speed really. The speed of the market slows down. So the more and higher you keep pushing prices, the slower the market in theory should get, because when you have a Vega of, let's say, 8 or 7, or volatility, I mean, of 8 or 7. So when you have a VIX of 8 or 7, which it's never been that low from my understanding, but if you have a super low VIX, it basically means everybody knows the market's heading higher, everything's rosy, kind of, okay, we're heading higher, there's no problems. And we're only heading higher by like 3 points, 1 point, 50 cents, $1, $2, not like 20 points, not like 15 points. Sometimes you'll get those blips of 10, 20 points, but it usually slows down the markets. That's why professional traders love sell-offs. They love a higher VIX because you're able to buy on the dips, or now the option premiums go up, because if you look at this and you had let's just say a higher volatility, right? So if right here we're negative volatility, if we had higher volatility, okay, you can see how you're actually losing money here, right? But that also means that this premium would cost more, right? So this premium would cost more. And if you're a seller of premium, you would be selling this for more money. Okay, so you would actually be selling it for more money. I know it's a little bit confusing. There's a lot of elements, cause and effects that go there, but basically, instead of selling it for, let's say, 270, this would sell for, let's say, I don't know, 340, depending on the VIX. And that's how ultimately the Vega helps or controls the VIX. I hope that kind of makes a little bit more sense. It's not directly tied into it from my understanding. It's more along the lines of how much time value you have. But if the VIX is low, you typically don't, when the VIX is low, you typically don't want to sell iron condors because, well, when you sell iron condors with a low VIX, you're kind of getting the picture would look the same with if you had a low VIX, but it would be tighter. With a high VIX, I'll make it in orange, would be kind of right here. But if with a low VIX, it would be more like right there, right within the yellow. So basically, and you'd get the same amount of money. So with a higher the VIX, these option premiums becomes more expensive. So why does that work, or why does this happen? Well, it's simply put because when you have a high VIX, what happens to the market? When the VIX is high, right? So when you have like this big November VIX that pops, or like this over here, this is like the Brexit era. So when you have a high VIX like this, it's usually because, well, people want to buy protection. It's the put to call ratio, right? It's the demand for those puts. So when the market's selling off in a big way, people want puts because they want puts, and you're a seller of puts, it drives the prices of those puts higher. So you being a seller, creating an iron condor, it allows you to sell those puts or calls for more money. It allows you to sell those options for more money. So I hope that ultimately makes sense. And as you can see how even relating it to options, you're still a contrarian in the marketplace, because when everybody else over here is selling off in a big way, call it right here or in this way, when everybody's selling off and the market is selling off, you're actually selling the puts, right? When they want puts, you're giving them the puts. On the flip side, when the market is heading higher like this, you're buying time premium, like calendars, right? Or diagonals. You're buying time premium because volatility is cheap, which means prices of options are cheap, so you can afford to buy a time premium. So ultimately, that's what it means to be a contrarian, whether you're trading stocks on a regular basis, trading, positions in shares, or even in options. And it really just comes down to personal preference of what you're doing, whether that's shares or whether that's options, totally up to you. Keep in mind, you're always looking to hedge your position. You always want to make sure you be careful if things go against you. If things don't work out in your favor, what are you going to do? Ultimately, that's the big question. You always want to keep that in mind. But in general, this typically is the way that you do things in the marketplace to capitalize from being a contrarian and also to make things work out in your favor. So even if you have here the upside and you went on and put on some calendar positions right here, eventually you get a higher VIX pop right there, a pullback, and your calendar decayed a bit, and you get out. If you had two calendars, you get out one calendar and you can hold on to another one. And if it gets outside your range, you're out of that position and you could create the next one again and again and again. So, anyways, that's how you typically do it. And I hope this was helpful and gave you some insights to looking at the market in a contrarian way and how you would ultimately uh, go in on a contrarian basis. So those are some of the things that I've went in and discussed and I wanted to discuss. Sorry, I don't have my pen and paper here. Actually, I'm redoing my office, so everything has to be on screen for the time being. But in either case, if it doesn't mean that you can't follow the trend. It just simply means you don't follow the actions of the group. So if it's an up day, it doesn't mean you buy on an up day. Okay, so that's what it comes down to. And a lot of the issues, the emotional issues, they're difficult in the marketplace. And sometimes it's weeks where you're feeling these things, but then eventually it all works out because you know the bigger picture in mind. And that's very tough for many people to learn. So I hope this was helpful. Are there any other questions regarding the things that we kind of covered, or any other specific questions that you have in general that we can cover? I'll give you a minute to write any additional questions for the time being if you have any, so we can cover them. Otherwise, if we just take a look at the markets here, Amazon, they're coming in and they're popping into these higher prices. The same thing with the SPX. I mean, we are stretched, but this is still a freight train. It's pushing higher. It's moving along. A lot of strength behind this move. but a lot of it is just talk on air, on a speech. So you have to keep the bigger picture in mind that you can still keep pushing it. You can push it, but eventually that fuel does run out. Even if you look at Facebook, we're pushing into these higher prices. Tesla, even though this stock, I'm fairly negative on this stock. I think in a longer term it'll probably see a little bit lower prices, but it's getting a little bounce right here from that market, even on the moving average. But you can see the volume to the downside right there. All right, so no more questions. All right, well, thanks for joining me this evening. I hope you enjoyed the lesson. Truly appreciate it. In the end, remember, do what you love, contribute to other people, but most importantly, live life abundantly. And I hope to see you in the next live class. Thanks again. See you next time.